Welcome back to the final round. It's time for a retirement segment brought to you by Fidelity Investments. So stocks today losing some steam. We have the S&P and NASDAQ both closing at their lows of the session. So with just 2.5 weeks to go until Election Day, how should you position your retirement portfolio? For more on this, we want to bring in Alex Reffett. He's a principal and co-founder of East Paces Group. And Alex, great to have you on the show. Just first, let's start with how are you advising your clients? What are you advising your clients to do with about 2.5 weeks left till Election Day? And we also have coronavirus cases ticking up across the U.S.
Yeah, thanks, Shauna. You kind of nailed it on that second point. The politics tend to be more of an emotional conversation. Every election cycle comes around, you've got a country on its heels and a lot of people that are going to be disappointed one way or the other. So you've got some emotional trading that generally happens around an election cycle. But actually, is this year, COVID has really been the driving factor in the economy, obviously, and still is. It's kind of very analogous to Obama's first term, where instead of the presidency being the biggest economic issue, you had the financial crisis back then. So I think COVID is, and the stimulus possibilities that may come from it, are more of the real economic impact over the next few months.
So with that in mind, what are you telling your clients to do right now, just in terms of how they should position themselves? Because there are so many uncertainties out there. Like you said, it's beyond just the election. When we have coronavirus, there's no clear path as to when exactly we are going to get a vaccine and how readily that potential vaccine is going to be available. So when we think about the fact that we could see more volatility now for quite some time, what should people be doing with their retirement portfolios?
Sure. Well, I mean, any major event, whether it's an election cycle or a viral outbreak like we've had, you need to be rebalancing your portfolio on a relatively regular basis because times change. There's companies that come and go and sectors that come and go. We have been a believer for a long time that we're in a technology bull market. Obviously, this year has demonstrated how resilient technology is. Obviously, there's a lot of things that are actually more profitable in a world where people are a little bit more disconnected socially and leaning a little bit heavier on the technology side. So I would say it's always important to have someone rebalancing their portfolio, looking at what's happening in the world and identifying where value is. And it's not going to be a surprise to me if technology continues to be a place of value over the coming decade.
Hey, Alex, Rick Newman here. Would there be anything wrong with shutting off access to your portfolio and not even looking at it until February 1st, 2021?
Yeah. I mean, the good old sell in May and go away, just another version of that. I think, honestly, people looking at their portfolio relatively infrequently, if they've got somebody managing it, is probably one of the best things they can do. It's like climbing a hill and looking at a yo-yo as you're walking up. It'll kind of make you dizzy. There's not a lot of value to staring at it day to day, unless, of course, you're managing it yourself. But even if you are, if you're buying valuable things, you can't be focused on the volatility of them on a day-to-day basis. You've got to be thinking, where's the world going? What are people moving away from? What are people moving toward from an economic perspective? And making sure you're in those places for the better part of decades, not necessarily on a day-to-day basis. So yes, I would always be in favor of people buying valuable, sensible investments and trying not to pay attention to them day to day.
Alex, Stan Halley, I want to ask if you have any, strategies for people who are looking to avoid any potential downward activity we see from the tech sector as the economy starts to bounce back, or when that happens, as far as people being able to go back outside or go to their offices. You got to expect we may see a rubber band effect. So I guess, what do you think people should do for their retirement funds as far as that goes? Should they try to rebalance them themselves, or should they just allow it to go through whatever kind of company that they have their 401k with, for instance?
That really depends on the individual and how far they are from retirement. Obviously, it's hard to give general advice in that framework because everyone's a little bit different. But what I can say is that you really want to make sure that you've got a portion of your portfolio. I usually recommend at least 3 to 5 years in something that's liquid and not going to be affected by market volatility. And what that gives you is the ability to let the rest of those assets ride. You look at the longest, the worst of recessions and how long they last. and you really want to have your equity bucket, in a position to where you don't need to be selling during a 3 to 5 year window. So if you've got enough cash for your living expenses for that period of time, if you're approaching retirement, that's really all you need. The difficult part is the conventional bond bucket, where people used to be able to allocate 30, 40, 50% of their portfolio to as they approach retirement, is a little bit tougher these days because interest rates just came down again this year, and they pay you basically nothing. So really people are having to lean on cash, and short and sweet of it is, if you need $50,000 a year to live in retirement, then I'd recommend you've got 3, 4, 5 years of that cash supply laying around if you're about to retire. If you're younger, not planning on touching it, you've got a secure job, I'd hardly worried about it at all.
All right, Alex Reffett, principal and co-founder at East Pieces Group. Great to have you on the show. Have a good weekend.
Thanks for having me.